We're going to be getting into an outlook for the banking sector in the second half of 2025 from Vetiva Capital Management Limited. Let's take a look at the front page of that particular report that looks again at the second half of 2025. There it is, H2 2025 banking outlook. We're happy to have Yemisi Sumola, who's a banking research analyst with Vetiva Capital Management, to discuss this report with us. Welcome to the show. Good to see you, Yemisi. One of the metrics that you touch on this report is the net interest income of the banks, and you've given a forecast as to what you expect in terms of the average NII. But for the benefit of our viewers, can you please define the net interest income for the banks?
Net interest income of the banks is basically what the bank earns from their core banking operations. So that is, we have the loans they give out, the interest they earn on loans and advances they give to their customer, subtracted by the amount of interest they pay to their depositors. So that's what actually constitutes the net interest income. Fantastic.
Now, you actually pointed out that the first half of this year, net interest income averaged about 54% for the banks. What was the driver? What drove that?
The major driver we saw was the elevated rates that fed off what we saw happen in 2024. We saw if the elevated rate actually fed into 2025, hence the uptick we saw and the resilience we saw in their interest income numbers. However, in the second half of the year, we expect a bit of a moderation, hence the 20% year-on-year projection in net interest growth.
Okay. Now, there's a chart you've had up there where you are anticipating that net interest income is going to grow by about 20%, which is for the second half of the year, yes, which is pretty much a slowdown from what we saw in the first half. That's 54 to 20. So why the drop?
So we expect that given the relative stability we've seen in inflation numbers since even the rebasing, we expect that the CBN would adopt a more softer approach in terms of their keeping rates at elevated levels, and with the moderation in interest rates, we expect that will also trickle into the banking financials and cause some sort of stability and moderation in their interest income growth.
Loan book. You are forecasting, I think, 19% year-on-year growth in the loan book of the sector compared to the prior one. But you're saying that the banks are going to be applying some caution to the loans that they extend. Why is that?
Yeah, so we expect that the banks will be modest in their loan books, whereby they will prioritize high-quality, short-tenor instruments, investments to depositors, majorly focusing in areas probably in manufacturing, oil and gas, short-tenor, high-quality, as well as further investments in investment securities, given the high interest rate environment. So that would be, as well as some trading transactions they would undergo. So hence the modest growth we project in loans.
That chart you've got, if you go back to it, Access Corp, First Holdco, and UBA and Zenith. I mean, they've got, as far as their gross loans, what you're looking at, much larger than the others. There's larger portfolios, or what? What's behind theirs being outsized compared to the other banks?
So, they are known as the Tier 1 banks, so they are the big banks. And so they are known basically because they have a larger scale as well as diversified operations, which would allow them actually invest in some areas such as oil and gas that are very capital intensive. And given their strong capital base, they have a stronger buffer to actually absorb a lot of these loan requirements, as well as absorb a lot of the credit risk as regards that.
Okay, so but then that now translates into the impairment side of the conversation. You folks are forecasting, I think, an 86% increase in forbearance. So talk to us about that. And I guess some of them are larger than others. What's the trigger behind that? Why you're seeing larger amounts of impairments?
So that would largely be as a result of the regulatory forbearance, where the CBN mandated that the banks should actually halt on dividend payments until they fully exit all their forbearance exposure. So what we basically adopted was a worst-case scenario approach, where we said, given the worst-case scenario whereby the banks fully front load all the forbearance exposures, we expect that there would be a significant spike in their impairment charges year on year, and which would largely cause
push that number up.
Push the number up.
Okay, so let's go to non-interest, or rather, non-interest revenues. What's been the driver of that? Because you are forecasting, I think it's 17% growth for non-interest revenues. What's behind the non-interest revenues for the banks, and then how come why are you forecasting that it's the double-digit growth there?
So over the first quarter of the year, we saw some sort of a slowdown in the trading income. That's what basically constitutes the non-interest revenue, is largely what the bank gets from fees and commissions, as well as investment in securities, as well as trading in FX and the likes. So what we saw was there was some sort of a downturn in the amount of their FX revenue, not across board, but for a lot of the tickers. So we saw a downturn of around 16%, a slight moderation. So our outlook is we expect that these banks are able to rebalance their portfolio positions as well, and exit a lot of their positions, hence the modest rise by 17% we project year on year.
What about profit after tax? You're seeing a 10% increase there. What's your driver there?
So we expect that, although we expect that core bank earnings will remain resilient, as well as some resilience we'll see in the net interest, non-interest revenue, we expect that for the impairment charges will significantly affect a lot of the banks under our coverage, hence the modest 10% projection in across board on average for the banks.
Okay, well look, the banking sector, as far as the NGX is concerned, it's been pretty liquid. And I know the report pointed out some particular banks where you're looking at the performance of their stocks. Any ones that you guys like in terms of a buy, sell, hold rating for some of these, following the names?
So from a valuation perspective, banks like Stanbic and JITCO are very, very solid as regards, one, the fact that they do not have any forbearance exposures at all. Even the fact that JITCO is currently listed on the London Stock Exchange serves as some sort of buffer, which could imply there could be further foreign investments coming into the stock. So, as well as the fact that even so, they've been able to maintain resilience in terms of their net interest margin, as well as their income from other sectors of operations. So we expect that they would also remain resilient. Zenith Bank is also known for high profitability despite its significant forbearance exposure. That is another stock that we also believe that would remain resilient in the medium to long term. Okay. Thanks.
A little bit of tier 2 and tier 1 mix there. Yemisi Sumola, banking research analyst at Vetiva. Thank you so much for taking us through this report. Really appreciate your insight.
Thank you very much.